Imagine this. A company, maybe one you remember facing some really tough times not too long ago. Now picture them pulling off something pretty remarkable. 7 straight quarters where their profits keep growing, one after the other. That's not just a comeback story, is it? It's almost like a masterclass in getting things right financially. Welcome to the deep dive. Today we're going to try and cut through all the noise surrounding the latest results from Yes Bank, specifically their Q1 for fiscal year 26. Our mission really is to take their own materials, earnings call transcripts, press releases, investors' slides, and pull out the stuff that actually matters, the real insights. Think of this as your shortcut to getting properly informed about a pretty significant player in Indian banking, and hopefully you'll pick up some surprising facts and, well, practical takeaways you can use to understand any company's health. Okay, so let's start unpacking this story. The main number that jumps out is the net profit for the quarter. It soared to 801 crores rupees. Now, for context, 1 crore is 10 million rupees, so that's what, around 96 million US dollars. A solid number. But here's where it gets really interesting, I think. This is their seventh straight quarter of sequential profit expansion. That kind of consistency, especially for a bank with their, let's say, recent history, it signals something important is happening.
It absolutely does. And what's fascinating, like you said, isn't just that single number, 801 crores. It's the pattern, the consistency. For a bank that went through such significant challenges back in 2020, hitting 7 quarters in a row of better profits, well, it really shows a strong underlying operational discipline kicking in.
Mhm.
And we're seeing it in other metrics too. Look at their return on assets, the ROA, basically how well they use their assets to make money. That's up to 0.8% now from 0.5% just a year ago. And management isn't stopping there. They've set some pretty ambitious targets, 1% ROA by the end of this fiscal year, FY26, and they're aiming for 1.5% by FY30.
So it's not just a lucky streak, it feels like a plan.
Exactly.
Yeah.
It signals a very clear, methodical path towards being more efficient and creating more value. And look at their pre-provisioning operating profit, that's profit before setting aside money for potential bad loans. That also grew for the fourth quarter straight, hitting 1,358 crores. That points to stable core lending profitability, good income from their treasury operations, and keeping a tight grip on expenses.
Right. That consistency is definitely the headline. But, for any company, you need to understand how they're making that money. So let's dig into the revenue streams a bit. Where's it coming from? What's changing? We see net interest income. That's the basic bank profit from lending minus deposit costs, up a solid 5.7% compared to last year. That's 2,371 crores. Seems decent.
It is decent, yeah.
But then look at non-interest income. This shot up by a massive 46.1% year on year. Is that, sustainable, or is there maybe a one-off element in there? What's the secret sauce, as they say?
That's a great question. It really gets to the heart of their strategy and the mix of their earnings. So the net interest income, the NII increase you mentioned, that's mainly because they managed to lower their cost of funds.
Okay. So getting money cheaper.
Essentially, yes.
Yeah.
Getting their raw material money cheaper. That's a really positive sign for a bank. Now, their net interest margin, or NIM, that a core profitability ratio, it was actually flat compared to the previous quarter at 2.5%. But importantly, it's up 10 basis points compared to the same quarter last year. A basis point is just 1/100 of a percent, so 0.1%.
Right.
And they achieved that partly by proactively cutting the interest rates they pay on savings accounts and some term deposits, though some of that benefit was offset because some of their existing loans got repriced at slightly lower rates.
Okay, makes sense. But that huge jump in non-interest income.
Yeah, that surge. It is significant.
Yeah.
And you're right to ask about sustainability. A large chunk of that came from treasury income.
Yeah.
They had realized and unrealized gains on their investments amounting to 484 crores. Compare that to the same quarter last year, where that figure was actually negative. A big swing.
So investment gains played a big role.
A very big role. Now, core fees, things like transaction fees, they also grew, but much more modestly, about 3% year on year. Retail banking is chipping in nicely there, contributing about 56% of those core fees. So while those treasury gains really stand out, and yes, they can fluctuate quarter to quarter, the overall picture shows the bank is definitely working on diversifying how it makes money.
Okay, so it sounds like they're getting smarter, maybe more efficient about both sides of the coin, getting funds in and lending them out, and also finding other ways to generate scam, which I guess leads us right to the core of banking. Deposits coming in, loans going out. Their total deposits grew 4.1% year on year, reaching 2.75 lakh crores. That's 2.75 trillion rupees, or about 33 billion US dollars. Good growth. But their overall loans or advances grew slightly faster at 5.0%. How are they balancing that? How do they make sure it's, sustainable quality growth, not just chasing numbers?
That's precisely the word, quality. It seems to be quality over just sheer volume right now. The bank talks a lot about granularization of deposits. That's key here,
Granularization, meaning?
meaning they're focusing less on chasing big, potentially flighty institutional deposits and more on growing smaller, stickier deposits from retail customers and through their branches. And those specific deposits saw really strong growth, up 20% year on year. They now make up a big chunk of a total, about 1.69 lakh crores.
Okay, so more stable funding.
Exactly. And related to that, their CASA ratio, current account savings account ratio, improved by 200 basis points, or 2 full percentage points, year on year. It's now 32.8%.
And why is CASA important again?
Because current accounts usually pay no interest, and savings accounts pay very little. So a higher CASA ratio means a larger portion of your funding is low cost. It's healthier, more stable.
Got it. And on the other side, the lending.
Well, while the overall loan growth was 5.0%, like you said, they seem to be quite selective about where that growth is coming from. We're seeing strong growth, for instance, in commercial banking that's up 19% year on year, and micro-enterprise banking up over 11%. These are often seen as potentially less risky or more relationship-driven segments compared to, say, unsecured consumer loans.
So a deliberate choice.
It really reflects what they call a calibrated approach. They're focusing on profitable growth, even if that means the headline growth in, say, the broader retail banking loan book looks a bit flatter year on year for now. Their target for the full year is still 12–15% overall credit growth. They seem confident they can pick up the pace after what's usually a slower first quarter for banks.
So that strategic mix, the focus on granular deposits and selective lending, that signals stability to you.
It absolutely does. It's about building a more resilient balance sheet for the long haul.
Okay, resilience is key. And after the challenges Yes Bank faced a few years back, asset quality, the health of those loans is always going to be under the microscope. Looking at their portfolio now, what's the real picture? How healthy is the loan book, really? Are there any sort of red flags popping up, or does it align with the positive profit story?
Yeah, it's absolute critical to look closely at that, and honestly. The asset quality metrics look stable and actually quite healthy, especially given where they've come from. Their gross non-performing assets, GNPA, basically loans that are seriously overdue that stood at 1.6%. It's flat compared to the last quarter and actually down slightly 10 basis points from a year ago.
1.6% GNPA. Okay.
And the net non-performing assets, NNPA, that's the bad loans. After they've set aside provisions or buffers, that's even lower, it's just 0.3%. Also flat quarter on quarter and down 20 basis points from last year. Very low. Plus, their provision coverage ratio, PCR, which shows how much of the bad loans are covered by these buffers, has improved further to 80.2%. That's a strong cushion against potential losses.
So the buffers are strong, but are new problems emerging? Any increase in loans going bad?
Well, there was an increase in what they call fresh gross slippages loans turning bad during the quarter. That figure was 1,458 crores. But, and this is important, they indicated these were mainly from specific isolated pockets areas like microfinance, some small enterprise loans, and also mortgages. And crucially, they noted that unsecured segments like personal loans and credit cards, which sometimes worry analysts more, those actually showed improvement, meaning fewer slippages.
Okay, so context matters there.
It does. And they're also still actively resolving old issues. They had total recoveries and upgrades of INR 1,170 crores during the quarter. That includes about 338 crores recovered from these things called security receipts, which are basically packages of old bad loans they're working through. They expect to get around 1,200 crores from those SRs for the whole year.
So cleaning up the past while managing the present.
Pretty much. And underpinning all this, their core capital strength looks good. The CET1 ratio, a key measure, improved to 14.0%. Management explicitly said there's no immediate need to raise more capital. And their liquidity is healthy too. The liquidity coverage ratio, LCR, averaged at 135.8%, well above requirements.
Right. So it sounds like they've really shored up the foundations.
It really does demonstrate a disciplined approach to managing risk and building that financial strength.
What's also fascinating, I think, is that it's not just the internal numbers looking better. There seems to be some significant external validation coming through, too. We've heard about a major international bank potentially coming in as a shareholder.
Yeah.
And credit rating upgrades. How do these strategic moves fit into the bigger picture beyond just the quarterly financials?
Yeah, connecting the dots here is important. That agreement for Sumitomo Mitsui Corporation Bank,
Yeah.
SMBC, a major Japanese banking group to buy a 20% stake, is hugely significant.
Elsa.
Well, first, it's coming from existing shareholders, mainly the State Bank of India selling down its stake. It's not Yes Bank issuing new shares to raise capital.
Okay, so a secondary transaction.
Exactly. It's expected to close around September. And it's just a massive vote of confidence from a global player like SMBC. It
Yeah.
potentially brings not just capital stability reassurance, but access to SMBC's global expertise, maybe opening doors for Yes Bank internationally or in certain product areas.
Right. And the rating upgrades, why do those matter so much in practical terms?
That's a great point. Moody's, ICRA, CARE, these are major rating agencies. They've all upgraded Yes Bank's long-term ratings and outlook recently. This isn't just, getting a better report card. It directly reflects the stronger financial fundamentals we've been talking about, the improved ability to absorb losses. And, practically, it makes it easier and, crucially, cheaper for the bank to borrow money in the wholesale markets, if or when they need to. It lowers their funding costs.
Okay, cheaper borrowing, strategic partner. What else? Are they keeping up with the digital side of banking?
They seem very focused on it. They actually got a special mention at the Digital Payment Awards this year for their work on fraud prevention and customer service through digital channels. That shows real-world impact. They have their apps like Iris by Yes Bank and Yes Pay, which seem popular. And looking ahead, they're talking about integrating enterprise AI and generative AI.
AI in banking. How would that work?
Well, imagine using AI to automate more routine tasks, maybe in loan processing or customer queries, or using Gen AI to help relationship managers prepare better for client meetings. The goal is to drive efficiency, reduce costs. They plan to start reporting on specific key performance indicators, KPIs, related to these AI initiatives soon.
Interesting. Okay, one last thing investors often ask about dividends. Any news on that front?
Yeah, it came up on their earnings call. Management basically reiterated their stance. The board will consider putting a dividend policy in place once certain financial benchmarks are consistently met. They acknowledge, that investors like regular income, but they're still balancing that with the need to ensure the bank's recovery is solid and they have enough capital for continued growth. It's a balancing act.
Right. Makes sense. Wow, what a deep dive that was. We've really seen a bank that's not just, steadying the ship after rough seas, but seems to be actively charting a new course towards profitable growth. And it looks supported by some smart strategic choices, those improving financials we discussed, and a pretty clear focus on the future, including digital and partnerships.
Absolutely. This deep dive into Yes Bank's Q1 results really paints a picture of disciplined strategy execution. They're clearly balancing that desire for growth with very careful risk management. And considering their journey, from the brink of crisis just a few years ago to this consistent profitability now, it makes you think. What insights can you, listening to this, maybe take away from their approach, particularly the focus on profitable growth, not just growth at any cost? How could you maybe apply that idea, that discipline, to managing your own resources or planning your own strategy, whether that's in your personal finances or maybe even in your professional life? Something to mull over.